Morning everyone, and welcome to the Prescient Investment Management Multi-Asset Update. Joining me in studio today is Bastian Teichgreeber, Chief Investment Officer for Prescient Investment Management, and then our co-head of multi-asset, Odwa Sihlobo. My name is Ray Mere, and I am the head of retail at Prescient. Today we're going to touch on our multi-asset process, our multi-asset fund, but particularly the balance fund. And I'm going to ask these two gentlemen to just take us through current positioning of the fund and also performance of the fund and kind of the outlook that we look forward to going forward. And with that in mind, I'd like to start with you, Basti. You and I spent quite a few weeks on the road telling clients that we're likely to be in a recession, a global recession. And although it's going to be painful, we think it's going to be a mild recession, and that's why we don't think people should panic. What are you seeing currently in the global economy?
Yeah, that's a good question. It is like that. I mean, you're right. We said it a few weeks ago that we're seeing a significant economic slowdown. It's exactly what we've picked up early and exactly what our models suggest. Having said that, it's not quite clear if we actually can call it a recession, because the National Bureau of Economic Research would not classify it as a recession because we have a very strong labor market. So we're getting quite mixed signals. What our models are suggesting is that yes, we are in a recession as we speak, but it's a very shallow and very short-lived one, and we are already on our way out. So I guess the easiest is if I just show it to you in some charts. Okay, so the way we predict the global economy and basically measure the performance of the global economy in real time is that we look at our present economic indicator. Our present economic indicator is our own in-house nowcasting, with which we get a glimpse of what the economy is doing in real time. So if I just zoom in a little bit and see what this chart is telling us right now, you can see we pick up, for example, in the great financial crisis quite quickly, quite timely. I mean, even like early 2008, we know there's something coming. If we look into the COVID crisis, we can see that already March, April, and when we saw the hard lockdowns, we immediately pick up the knock, so to say, to the economy. Where we are right now, as you can see on the right-hand side of this chart, we see this quite shallow recession basically hitting us, but you can see that we are already on the way out. So long story short, yes, there's a little bit of an economic downturn happening as we speak, but we are already on our way out. So it doesn't look like the world is coming to an end, so to say. It doesn't look like the wheels are coming off. And we also want to reiterate that a recession is part of every business cycle. So it doesn't mean that we need to get too bearish here.
Great, thanks, Basti. So you think the recession is not going to be a deep recession, but is that not deflationary in itself?
It should be deflationary, and that's the interesting bit, because we're all talking about these high levels of inflation and whether they finally come off. And we've long been saying that inflation is to come down, but it is remaining frustratingly sticky. So yes, in itself, it most definitely needs to be deflationary. But the issue which we are facing is that, again, it's not an issue, it's actually a good thing that this recession is not particularly deep. So we have a very strong labor market, very strong consumer, very strong corporates actually, with very strong corporate balance sheets in the States. And that means that actually price pressures can manage to prevail longer than what we initially expected.
Okay, so I've just relocated to Cape Town. I made what could be a big mistake of buying a property now. These interest rates are killing me. So I sit there and I'm wondering what is driving US inflation? Yeah,
I mean, we can look at the individual components, and I mean, we always make the case that inflation is heavily supply side driven, so not so much demand side driven. And that in itself is a strong reason why we think it is actually more temporary than the headlines suggest. But maybe let me take you through it a little bit more in detail and show you the numbers. Okay, so if we look at US inflation basically on a year-on-year basis, you can see that in this chart we have peaked at just above 9% at the top here a few months ago, and that we are coming down slowly but steadily. So if we speak about inflation being supply side driven, we speak about these elements. So you can see this red area at the bottom here, which normally historically never really features. So you can see if you go back in the chart that only normally a very small contribution. This is basically new and used motor vehicles driving inflation, and you can see how this is coming down. So this is exactly the evidence that there is some easing in supply chain issues. The same is happening here with motor fuel, basically driven by the oil price. You can see historically big contributions, but very volatile. And the oil price has basically come off its peak. So the supply side driven inflation is really starting to come off. Give you another example. Here we can see food. So we hear a lot about food prices driving inflation because of the Ukrainian crisis, and that's what we can see here. But also that is starting to come off slowly. So we are right in our inflation theme if we say that inflation is coming down, but here's the problem, and that's where we have to be cautious. We have this big element of shelter, and Ray, that's exactly to your point. Shelter is not the same as house prices. It's basically owner's equivalent rent and rent itself, but it is very close to house prices. And you can see that the bars, the blue bars, which highlight the inflation contribution to shelter, have actually increased over the recent past, which means that, yes, we start to see more sticky inflation elements coming through slowly but steadily as well. And that's obviously what kept the Fed hiking interest rates by another 75 pips just now.
Okay, so now let's bring that to South Africa. So that is what they're doing in the US, and that's what the Fed's doing. Our Reserve Bank, what is their approach to kind of curbing inflation? And also, should it be the same approach given the fact that our economies are very different and at very, very different cycles?
That's a good question. So, I mean, yes, our economies are very different and at very different points of the cycle, and the drivers of inflation itself are also different. But what remains the same is the mandate of the Federal Reserve and the SARB. For both of them, it's absolutely crucial to keep inflation in check. So that's where they have the same task, the same mandate. So what does the SARB do? Well, I just mentioned that the Fed has hiked another 75 basis points. It's in fact the third consecutive 75 basis point hike. And the SARB is following. And I guess what we really need to observe is how long can we follow, because the Fed can manage to push through hike after hike after hike because they've got this strong economy, got this strong corporate balance sheet, which I mentioned, strong consumer, strong labor market in itself, while us in South Africa, we're at the other end of the spectrum. So yes, we have to follow the Fed also to keep our currency strong, but the reality is it's a question of for how long we can do that, and I do think that we can't do that, keep up with that pace for good.
Okay. Odwa, so now Basti's given us a bit of a macro outlook, and so, I mean, global recession, potentially, we're saying we're hopefully at the end of a hiking cycle in terms of interest rates. How does that, let's take it back to our funds, and particularly your space in the multi-asset area. How does that look? How are you positioned in the balance fund?
Right, thanks, Ray. I mean, to answer that holistically, we are very much bullish on South African assets, right? For example, we love South African bonds because of the high real yields that are currently embedded in there. Again, as a result of all this hiking, we have super high yields. So even on some of our income assets, right, with all of these interest rates hikes that are coming in, what we do is then we tend to increase the duration and take advantage of what the market is actually anticipating of these aggressive hikes. So that also works out quite well for our funds. Then on the equity side or growth asset side, we also do love South African equities. And what I'll do now is just take you through holistically across all of our different asset classes, what our overall views are. Our overall positioning across all the asset classes in our investment universe, you'll notice here that we are very strong overweight on South African equities, whereas on the developed market equities, we are underweight on those assets. If we look at the bond side, we really much do love South African bonds, but bonds from other geographies, we are a bit neutral on those. Another interesting view that we have in our portfolios is on the South African rand, which we think is quite undervalued, especially with the current levels that it has blown out to recently.
Okay, so from what I can see, you are more bullish on SA equities than you are on US equities, for example. Can you take us through that?
Correct, Ray. So here really, given that we like South African equities more and not so much US equities as an example, so what we do is we sell some of that US equity holding, and we then use that money to fund buying the South African equity holding. So what I will do quite quickly is just take you through the reasoning for these different views on this on the two equity asset classes. So for South African equities, you'll notice that when we look at our four factors that we consider, we are very much bullish on South African equities from a valuations perspective. That is, this indicator is telling us that these assets are very cheap relative to the value that they inherently hold. The economic story is quite neutral now. However, the financial conditions still persist that make this asset class also attractive. On the sentiment side, things have been turning around a little bit with a poor business sentiment and some consumer sentiment, as well as investor sentiment weighing us down. However, from a balance of all of these factors, we are still quite overweight for South African equities. So what we can also then do is start contrasting that with US equities, which we are currently negative on. When we look at US equities, what we find is that we're actually quite negative from valuations. That is, this market is really expensive, whereas in the South African market, it's actually quite cheap where it is. As Bastian also spoke towards, the economic environment in the US has been slowing down. Even though it is in a recovery, it is still growing below the trend that we would expect. Financial conditions still remain supportive, but even sentiment in the US as well is weighing down. So again, balancing all of these factors together, we end up with an overall negative score on this asset class. And that's why we have differing views for South African equities versus what we call developed market equities.
And so this has been our position for quite some time now, and how has it worked out in the funding?
Right, so Ray, from this US versus South African equity play that we've spoken about, so that has worked out quite well. However, when we look at the portfolio overall, the portfolio has been taking a little bit of pain. And when we look at the current positioning of the overall portfolio, we'll get to see why we've actually been getting a bit of hurt from by the markets right now. This pie chart depicts our current positioning in the portfolio. As I mentioned, we have increased our South African equity exposure, and we held slightly less developed market equities. However, as you can see, this portfolio is positioned again to take advantage of growth assets in order to achieve real returns. Again, it's really about the asset allocation, which is actually very well diversified and not necessarily too SA risk specific. But given what we've seen in this year in particular is that actually South Africa has fared much better than the offshore market, and that's what we're seeing in the performance. So here we just depict our overall position of the portfolio as we sit. As we mentioned, we are overweight South African equities, especially relative to, let's call it, developed market equities. And given that South African equities have outperformed the developed market equities, that has worked out quite well. However, you'll also notice that we are allocated to a lot of growth assets offshore, for example, emerging market equities, which again have all underperformed our South African assets. So really, if looking at it as a whole, like the sell-off that we've seen this year, we were not really sheltered from it too much, given that we are exposed to these growth assets, which we want to give us those long-term real returns in a very diversified manner.
Something that I love seeing on your pie chart that I don't normally see with our competitors or in other multi-asset funds is that allocation, the full allocation to infrastructure and clean energy, South African infrastructure and South African clean energy. Can you take us a bit through that?
Yeah, so that's actually quite a nice and attractive allocation. So that is our in-house allocation to the in-house funds on clean energy and infrastructure. And it's one of the most tangible and real ESG components that we have in our portfolio. And I mean, currently we are, for example, in an energy crisis in our country, and these funds are really tailored in terms of being able to funding such projects, but in a very environmentally responsible way as well. And again, just to support the growth of the country. So it's one of the very nice, attractive assets we have. So by attractive, I mean it actually delivers very strong inflation-adjusted returns, but at super low volatility, in fact. So it's very well, it fits in very well in the portfolio, it diversifies, and it does not drag on performance. In fact, it elevates the overall performance for the portfolios.
Okay, so we've touched on strategic asset allocation, we've touched on tactical asset allocation. You've also shown us a bit of some of the kind of diversifiers that you have within the portfolio using some of our teams internally, which is clean energy and infrastructure. Knowing our investment process, and I think everyone knows the process, is we generate our alpha through portable alpha and through our fixed income capabilities. And I suppose the question is, how is that working for us? You can get the return that you get through the market, 100%, but how is our alpha profile looking at the moment?
Right. So you're right. Portable alpha is one of the big contributors to the outperformance in our funds. And as you already mentioned as well, it's very much built on fixed income assets. And with the aggressive increase in interest rates that we've seen, in fact, across the globe, as we know, interest rates are inversely related to the prices of these assets. So that's, again, has hurt us a little bit in this rate hiking cycle that we've seen. But having said that, what this really then means is that we are now sitting in a portable alpha position that has extremely high real yields baked into it, which actually bodes quite well going forward from that perspective.
Okay, so I also want to add one point there, Ray, because the key point which Odwa is making here is interest rates going up hurts us in the short term, which we have felt now in the fund performance, but interest rates being high and eventually topping off is particularly good for us. And it's quite easy to visualize it, so I want to quickly show you how that looks in the numbers.
Okay.
Okay, so what we can show on this chart is basically the contribution to our fund from one of our portable alpha strategies. And you can see, especially June, July, when we see the massive upside surprise from US inflation, that we are taking a knock in terms of alpha contribution. So we're showing here on the y-axis basically the alpha contribution in percentage points. Okay. The nice thing about our approach is that the alpha is quite predictable. Okay, so what I can do now is I can basically phase in and show how much yield these cover assets are going to generate over the next 12 months. So that accumulates to quite a lot. Okay, and we're already now taking into account all the interest rates hikes which are priced into the market. But obviously we're not going to generate 8% alpha here. So what we have to take off is basically the funding cost. So that's basically the cost for us basically funding our equity exposure through our fixed income holdings. So if I basically blend those two against each other and see what remains after we take off the funding costs from our portable alpha process, you can see that we have an expected alpha of roughly 1.6% on our fund. And the nice thing about this portable alpha approach is really that if we say expected alpha, it's quite predictable. So it's obviously not going to be as shallow and as slick as we would expect it on this chart, but we have all reason to expect that with all the hikes still coming through to produce 1.6% alpha from our portable alpha strategies over the next 12 months. And that's just, stands testament to the attractive environment and the high likelihood to generate outperformance over the months to come.
Thanks, Bastian. Odwa, so it sounds like rising interest rates, not great. High interest rates, fantastic. However, that means that you've had a bit of a turbulent time then in terms of performance. Can you actually show us the actual performance numbers of the balance fund?
Will do, right. So here what we have is the performance of our balance fund after fees. We also contrast it with our own in-house benchmark as well as the peer group aggregate as well. So what we'll see, we also then depict these same numbers, but in terms of these bar charts over here. So if we focus on the near-term performance, you'll notice that we are lagging behind versus our benchmark, which excludes fees, as well as the peer group. We've already alluded to the fact that the portable alpha has weighed quite heavily on the underperformance. We also mentioned that we allocated offshore quite a lot in terms of being able to deliver diversified performance for the portfolio, whereas our peer group has not necessarily gone offshore that much, similarly with the benchmark. So those were the two things that have weighed on the portfolio. But having said that, the great thing, as Bastian also showed us, is the potential that we're sitting on this portable alpha going forward. Again, when we do look at a longer term perspective, we still are above our peers, as we would expect, which stands testament to our process. So, we're not happy with these short-term performance numbers, but we're actually quite optimistic about the outlook. And again, you know, like we'll be closely watching the space, and we already have a sense of how that performance will unlock as we've spoken to right now.
Okay, great. It makes a lot of sense to me. I mean, I can see the 1 year number is not great, but like you guys have mentioned now, you can explain it through the process, which is always a good thing. You always want to make sure that a fund does what it says on the tin. And the explanation sounds solid, but now going forward, what you're saying is it's a great opportunity and an exciting time to be in the Prescient Balance Fund, given that we expect that hopefully we're at the end of the hiking cycle of interest rates. There's a lot of great yield baked in because of the higher interest rates. And I suppose if I look at Basti, if I look at your slide that showed kind of the expectations of 1.6% alpha expectation, this is a fantastic time to be in the fund. Having said that, you know, what could go wrong? Can interest rates continue to go up? You know, the last few years have been about this has never happened before. This is unprecedented. This, that. Can you tell me what can we? I like what you're saying. I'm glad I'm in the fund myself, and I'm glad it's looking great. What could go wrong though?
So you touched on the interest rates, and you're right. Like that's one potential risk, that interest rate hikes become more aggressive than what the market has been pricing in, and we still do think that is an unlikely. One of the reasons is we like how the Fed, for example, communicates to the market what their intentions are and what their path is likely to look like. So then the idea is that the market already has an idea what they are expecting to do going forward, right? So therefore, hopefully there won't be more surprises from that, right? And also, as Bastian showed, with the inflation, especially in the US as an example, having peaked and slightly starting to cool off, again, there's less reason for the Fed to surprise on hiking more than is currently expected. So that's why we're saying that it is a risk, however, it is very unlikely. But other maybe factors now that are again slightly unpredictable that could disturb the status quo, let's call it rise in geopolitical tensions, their likely impact on reducing risk appetite, constraining supply chain, again, because these again could maybe be bad for risk or growth assets and might also be bad for inflation, as what we've seen as well. So these are the risks, but with the current information, there's little evidence pointing in that direction, but there's more evidence of that things are actually now starting to calm down versus where we've been.
Okay, so on a balance of probabilities, you think it's less likely that interest rates will continue to go up, and if they do, you'll look very stupid.
Again, it's really based on that information, correct? And as I mentioned, it's very small probability, all right? And again, in order for us to have the best chance of succeeding, we have to go with what the probabilities are really pointing towards.
Fair enough. Basti?
Yeah, I agree with everything Odwa said. I mean, also just to put it a little bit into context and bring it back home. I mean, we have priced for another 10 hikes, at least 0.25% hikes. So basically 2.5% hikes are still priced into the market already. So seeing another 10 hikes, despite us starting to undershoot on core inflation, is a tough imagination, especially if one looks how stressed and how poor our consumer in South Africa right now is already and how weak the economy is. So it doesn't make sense to put through 10 hikes. We don't think it's going to happen. And even if 10 hikes are pushed through, we're just experiencing what is already priced for. So for us to really look stupid, as you put it, we would have to see significantly more than 10 hikes. Okay. And as Odwa said, the odds of that we see is really slim.
Okay, all right. That's a great outlook. Thank you very much, gentlemen. I think it's time for us to ask the audience for any questions, if you don't mind sticking around and answering those questions.
Sure.
Will do. Thank you.
Thank you.
Basti, Odwa, thanks very much. A couple of questions coming through. You mentioned that having increased offshore exposure when the regulations changed to allow Reg 28 funds to go 45% offshore detracted from the fund. And the question here is, can you take us through that in a bit more? Can you take us through that in a bit more detail?
Thanks, Ray. So I think what we'll do is just look at our current fund positioning quickly. So what you'll notice here as an example is, so this is our current positioning in the balanced fund, where we have a lot of South African equities and a lot of South African assets. But what's interesting is that we also have a full 45% allocation to offshore asset classes. Again, that was as a result of the new regulations that allow a lot more offshore exposure. So what this asset allocation has done is that it has immediately decreased our overall portfolio risk from before the new regulations came through. So we are way more well diversified. We are gaining our equity exposure. Instead of like a concentrated market like South Africa, we're gaining it from like more than 2,500 different companies across the globe. So that's quite the great diversification. So what has hurt us though is that even though we still have 55% of our assets in South Africa, what we found is that the South African assets have actually outperformed the offshore assets. So even though everything has been going down this year, i.e. Returns have been negative, South Africa has actually been more resilient than our offshore allocation. So that's one of the big contributors to the drag in performance, right? It's just the underperformance of offshore assets versus our local assets. However, I mean, from a strategic asset allocation, this portfolio really brings together the best of all mixes of growth assets to give us the best diversified view, like for the long-term investor. But as we mentioned, it's South African assets have just been more resilient in this turbulent market, and that's been one of the big contributors. Then when we also speak to our offshore allocation as well, recall that we use portable alpha in our strategies. So what that means is instead of buying these equities physically, we would buy futures and then invest that money into fixed income assets. And as we've seen the rates increasing quite aggressively across the globe recently, so we've seen that, as we know, like when yields go up, fixed income assets tend to have a drag on performance. So therefore, that's how we've also then been hurt from that portable alpha element. But the great thing is that with the increase in interest rates, that means that currently, from the current vantage point, is that the portable alpha process actually is sitting on a lot of embedded yield as of this point forward. And that's like one of the ways that we see value unlocking in this portfolio is now standing at these high yields going forward. We're just going to keep on accruing that interest, which therefore adds performance over and above all of these building blocks. So that's really, again, the context of us going more offshore, which has been taking advantage of the diversification, which a lot of our competitors have not necessarily done, while still managing overall portfolio risk. Thanks, Ray.
Thanks, Odwa. There's actually a follow-up question from Pierre asking for you to elaborate on the currency exposure and the process around that.
All right. So that's a great one as well. So what you'll notice here is even though we have 45% asset allocation offshore, you'll notice that we only 25% of that is in US dollars. So what I'm trying to say is if we go 45% offshore, that means that we have 45% exposure to the currency, the rand versus the US dollar. So but the problem with that though is that you then are exposed to any changes in the rand versus the dollar exchange rate, which we have seen quite recently is quite volatile, and it can go up aggressively and come down aggressively. So if we just went offshore like that, we would be adding risk to the overall portfolio. So what we've then done is we've actually hedged some of this offshore exposure back to rands, so that we only end up with almost like only 25% in let's call it physical dollars, as you would want to put it. Overall, given that we don't want to have too much rand volatility in the portfolio, so we'd like the rand dollar exchange rate, because we know in the long term the rand tends to depreciate against the dollar, which actually adds performance. But in the very short terms, the fluctuations can be too wild, which really make performance very volatile. So we don't want to have too much of that. So that's why we hedge it. Right, so we have 45% offshore, but only 25 of it is exposed to the rand dollar volatility. So that's one of the main keys about risk management in this portfolio. And that's what makes our current holdings, our current allocation actually less risky than what we had before.
Thanks, Odwa. Basti, question for you. You've mentioned a few times that yields are attractive, and the question here is, how attractive are they?
Yeah, thanks, Ray. Following up on that, just the screen quickly. Yields are very, very attractive now. And I always say it for our balanced fund, when yields are going up, it hurts us because of our basically portable alpha process. And as Odwa rightly said, yields up means price down for bonds or fixed income assets. So we take short-term pain, but it is definitely long-term gain, because what we can see is, on the x-axis just the current yield, and on the on the y-axis the current yields, expected returns, the yield to maturity, so to say. On the x-axis we have the different offshore fixed income asset classes. You can see that asset classes like high yield corporates, emerging market bonds, you really have yields above 9% now, and this is in dollars. Okay, and you don't have to go too aggressive. Even short duration high yield assets now yielding more than 8% in dollars. So yields have really moved up aggressively, and that obviously lays an amazing foundation for our balanced fund to leverage off the portable alpha framework. Because remember, our balanced fund is really almost 100% exposed to portable alpha. All our individual building blocks will benefit from these higher yields going forward.
Thanks, Basti. Another question for you from Donovan, asking, knowing that the market is forward-looking, do you believe the market is fully priced in a recession in the US? And if yes, would you consider the market has reached its potential bottom? And if so, how have you guys kind of positioned yourself?
Yeah, that's a good question. It depends on which market to look at. I guess that's what we clearly have to say. I mean, yes and no, because if we look into South African equities, you can see that the market has really priced us for a quite bad outlook. We are in the bottom decile when it comes to the forward PE ratio, creating a very strong value case for South African equities. Hence, we also have this strong overweight of South African equities in place, which is helping as we speak, but which hasn't helped so much over the last couple of months. So here we would say, yes, the market is priced for quite a negative outlook. If we look into the States, the story is slightly different. Valuations have come off dramatically here as well, but we are not at a particularly cheap market. We are looking at a market which is priced to like an average valuation level. And that is not particularly attractive if you now see that the global economy is in fact slowing, financial conditions are tightening, sentiment is turning more bearish. So we would say a fully priced a recession, no, not 100%, but it also shouldn't fully price a recession, because we don't have 100% certainty that there will be a significantly or very deep recession. But at the same point in time, has some repricing hasn't happened? Oh, yes, definitely, for sure, a lot of repricing has happened.
Thanks, Basti, and thank you, Odwa. That brings an end to our update, multi-asset update. On behalf of all of us at Prescient, we'd like to thank you for listening, and thank you for trusting us with your clients' money.
Thanks a lot.
Thank you. Bye.